And if you recall, the sterling shorts that we gave from that tweet were based around this accumulation zone. And you can see a classic accumulation in the background here. You can see that perfect structural accumulation phase. You can see how beautiful that accumulation phase was. This was the POC of that accumulation zone. This is the price that we sold off of back on the 19th. This is the price we tweeted yesterday, remember? If you remember, we tweeted a couple of days ago, and we said that we're going to be selling off that price. Yes, it's in the tweets, so you don't have to deny it. It's in the tweets. So that price still exists, doesn't it? It hasn't gone away. It still exists. It hasn't gone away. So when we start zooming down into the lower time frames and we start to see whether there was an opportunity to do business again here, you can see that in the overnight session we started to trade back up into that area coming into the London session. And you can see they accumulated, they ran stops, they ran sweeps, they try to push, they try to push, they try to push, and a nice little breakaway from that price. Now since then, they've been running this double distribution level. And you can see that they've tried to run the double distribution once here. Then they set up a paycheck. They set up a paycheck sweep. Do you see the paycheck sweep, guys? It's a beauty. So there was a little paycheck sweep just there short while ago. And you saw there was a brilliant little sweep. And obviously now there's a challenge on this one because we've got to try and get through this double distribution down that's holding the price in place here. So that double distribution down obviously found commercial buyers coming in off of this key level in the background here. So you can see this level was the halfback trade for the whole move. So when we head into this area here, there's obviously either a lot of profit takers or there is a genuine commercial buyer. But the good news is we can figure out what it is because we can look at value, can't we? We can look at value. Now, what kind of value would we want to look at? Well, there's a couple of values. When we look at the big picture like this hourly chart, the big values that we could look at are things like the carry trade, the shape of the relative value curves. So if I look at the relative value curve, for example, does anybody think we should be selling sterling? What do you think, guys, on relative value terms? Do you think we should be selling sterling or buying it? Well, according to the relative value curve, we should be selling lots of sterling, right? We should be selling a lot of sterling based on the relative value curve. We've got a lot of short-sided, potentially a lot of short-sided action developing on sterling because the sterling curve must be a lot flatter than the US curve. Now that's obviously a possible good thing. It could be a possible bad thing, but it's something we just simply appreciate and understand. And generally as a rule, when the relative value of the curve improves, as it did through this phase, you can see it's not the most rigid storyline because obviously there can be reasons for that, but when the relative value curve improves, as a rule, we would be buying lower prices on the currency markets, and you can see those lower prices result in a nice upside move. Not immediately, but it's not an immediate type trade. So when the relative value of the curve improves here, we can see again the same storyline as the price trades down into liquidity. And it's not an immediate move. We start buying up the bottom edges and we get a nice upside move. When the relative value of the curve is now dropping, we want to try and sell into the higher prices as it was over here. We can see that in the big macro global picture, we can see that they did exactly this on the global macro picture. So in the global macro picture, we can see that commercial sell zone in the background with the relative value of the curve dropping off really substantially with a short-term bid came in here, but then it stabilized. And it basically left all of this top edge for an accumulation. Well, that top edge accumulation took days. This is an hourly chart. The start of that accumulation was the 10th of May, and it never broke south until the 16th of June. The 10th of May to the 16th of June. That's 5 weeks. So when Paul's talking about the dollar being bought or sold, we need to understand that context, don't we? Because here's a sell trade that took 5 weeks to sell off in terms of value. So Forex markets get manipulated in these areas. There's a lot of other reasons why somebody may or may not put a bid into Forex, of course, but there's always that developing macro story that we always pay attention to. So this whole trade took 5 weeks of selling before the pound collapsed through the bottom edges. It's pretty obvious that it takes a long time on any market to develop into a strong sell. Talking of a strong sell, by the way, if you remember what we said about selling bonds, congratulations, all you guys that are short bonds with me. We sold off the 4s. It's just traded a low price there of 6s, nearly another $1,000 sell if anybody's in it. Anybody in it? Hope so. I hope so. Anyway, so yeah, so that's what we're looking at. Remember, we don't get instant responses. We don't get instant stories. We have to work to get the storyline. We have to understand that the storyline can take time. But at the present moment, this storyline is absolutely solid on the short side. Now, that's only one aspect of it. So in other words, the short curve is very, very bearish, the pound at the top edge. Pretty obvious. So when we move away from that and we start asking the question about the carry trade and we say, well, what is the carry trade doing? We can obviously look at the carry trade and try and answer the question. The carry trade is the reason why we ended up in this area in the first place, because the carry trade still made the pound biddable at lower prices. So when the carry trade makes the pound biddable in those areas, we just have to accept it and understand it. It's not about one part of the trade, it's about building a picture around these trades. If the carry trade is still bullish but the curve is bearish, there's going to be curve traders that are trading pounds long, and there's going to be there's carry trades that are trading the pound long, and there's going to be curve trades that are trading the pound short. So the pound will find buyers at low prices and find sellers at high prices. So when we see those elements and we start zooming into those elements, we can see the carry trade is definitely declining at higher prints up here. So we're seeing that carry trade declining at higher prints. So we can obviously start to recognize, again, the macro that's attached to sterling. It's a very, very strong storyline. What else do we want to see? Well, we want to see about risk. Sterling should be going up when risk is increasing, when risk on is increasing. So things like equity markets. Well, there's the perfect example of why sterling really is at the high print. Sterling benefits from a risk on environment massively because it's a financial services industry. So when equities are going higher, the one thing I don't ever do in sterling is really try and get too aggressive into the shorts. If I'm going to sell it, it's going to be at higher prints for a solid commercial reason. But inside this environment here, the S&P has kept going higher. So the kind of sterling trades that I like are these types of trades here. I like to sell sterling down into those areas there, because the S&P is actually starting to appear on the short side. So when the S&P picks up a bid, I generally, as a rule, try and be a buyer unless I have a macro reason to not be, and the curve has obviously been that macro reason. So we've got to build a picture just like every other market. Yes, we can sell it, but we want to try and sell it when this comes out a little bit here. So you saw it came out just there, you saw it came out there, you saw it came out on the pullback here, but you saw it starting to rotate back into a bull here, so you're very, very passive on these upticking phases. Very passive. It's like every other trade, isn't it? It's about a storyline. It's not about one line. It's not about one idea. It's about putting all the ideas together. Sterling is bullish in a risk-on environment. Risk-on, the easiest risk-on line is the S&P. The S&P is going up, I'm generally long sterling. The S&P is going down, I'm generally short sterling. As people rotate into long dollars, we obviously can understand. Well, when the equity market's still catching a bid, people will sell dollars, yeah? That's always been the case. If equity markets are catching a bid, people will sell dollars for two reasons. Number one, the big institutions may be rebalancing their portfolios. If the S&P is going up faster than the DAX and the FTSE, for example, they may be rebalancing their portfolios, so that's one reason to sell dollars. And number two, if people had bought dollars because of a risk-off scenario as a hedge, then obviously if equities catch a bid and hold on to the bid, people will start selling dollars because of that reason. They're unwinding their dollar long positions because the equity market's held on to a bid. So there's two reasons why people would sell dollars in that environment, two reasons therefore that people would buy the pound, two reasons why people might buy some euros. So we can start to recognize that this is exactly as you would have expected it to see. Pretty good stuff. Pretty easy stuff, guys. So our bond did well, thank you. We managed to make a fairly reasonable gain to the downside on treasuries. It's pulled the break-evens. The break-evens were a little bit high, which is why we were very, very, very passive on selling bonds. We certainly weren't going to get too involved in a fight with the bond market. So we started to see that. The belly had diverged off the high print as well, which was a really nice signal. It was just the best sell trade you'll see, guys, wasn't it, when you think about it? You see that? It's probably the best sell trade that you'll see. Let's take a look at the bond sell. This is a 1 minute ZB chart here. You can see that we've got some value coming in here from some of the markets. There's a bit of value drifting off here, but let's think about this from the curve point of view. We talked about this trade yesterday. Let's take a look at it from the 5s, 10s perspective. So where's the trough on the 5s, 10s? Where's the trough on the 5s, 10s? The trough on the 5s, 10s is either here or here. It doesn't make any difference which one you mark because they're both divergent. So if that's the trough, that should be the peak on the bond price, right? So the peak on the bond price should be this price area here. Everybody gets that from the 5s, 10s, yeah? So when the 5s, 10s starts rallying, obviously any higher bond price is obviously starting to put duration into our favor on the 5s, 10s, correct? So that's going to put duration into our favor on the bonds. Now, it's not just the 5s, 10s on this occasion, and sometimes there is just one. Sometimes we get a confusing picture. We have to rely on, other bits. But on this occasion, we're getting duration from the 5s, 10s. But it wasn't just the 5s, 10s we were getting duration from. If we look at the 2s, 5s, look at it. The 2s, 5s is actually going in the opposite direction. We're actually getting a bull steepener on the 2s, 5s. That's unusual. So we don't even have to think about this, do we? We don't even have to think about this. This is an automatic sell on the 2s, 5s. There's no question about what's going to happen next. The bond price will drop because we've now got duration all the way out to 10 years, Reeve. We've not just got duration out to 5 years. We've got duration out to 10 years. And obviously that's going to give you the perfect opportunity to get that bit of business done. Now with the 2s, 5s going higher, and the 5s, 10s going higher as well, what did the knob spread do? The knob spread started to sell off. Well, that's exactly what you would have thought was going to happen to the knob spread, and obviously in line with that trade narrative, everything started to play out. You've seen the price of bonds going higher, which caused the whole trade to appear in the first place, perhaps, which was nice. And obviously the sell we got off of the bonds at the top edge at 2s and 1s, drops down to low price of 16s, another $500 on the ZB contract. A very, 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 very profitable trade outcome. And really not that difficult. Now you might be saying, but what about possibly some delta hedgers coming in? Because perhaps the price is going higher because of delta hedging. Okay, we can verify whether that's the case. Oh, well, no, that's not true either. There is no delta hedging because equities are going up. Equities are going up. So if equities are going up, this isn't delta hedging. How can it be delta hedging when there's no deltas to hedge? So that's not the reason. That's not the reason. So it could well be obviously the story that I told you about this morning, this idea of, the Fed taper concept, but this time we're only seeing it appearing on short bonds. But we've been able to dismiss all the reasons why the bond is at higher prices. So now we've got a very strong reason to be selling bonds. Simple, easy, and an incredible profitable outcome. But not one trade again, is it? It's 1, it's 2, it's 3, it's possibly 4 trades to get the deal done, to get the deal sealed. It's maybe 4 times you've had to come into this top edge to get it working for you. So you've got to make sure you're ready to do the work. You've got to be ready to actually do the work. And this comes back to Steve's point from earlier. It's just about that phase. It's about the phase of execution against a story that you have a strong belief in, and you've got to be willing to put your money at risk to take advantage of what seems to be an absolute no-brainer bond trade. And that's what we're trying to understand, isn't it? That's what we're trying to get from this storyline as it evolves. It's not about one piece of that jigsaw puzzle. Number one, we saw the toxic sell off the top edges, which was nice. Number two, we saw a level which generated some upside liquidity. Number three, it was a wholesale price. Number four, we were seeing a steepener on the twos, fives. And number five, we were seeing a relative value steepener on the belly. So we had duration out to 10 years in our favor. It just becomes an absolute no-brainer for me as far as a short trade, and I just want to be short. I just want to make sure I make as much money as I can off that trade, because you don't get them very often. So when you get them, you get them.